In the first 4 trading days of December 2025, more than 47.6 million ounces of silver were claimed for physical delivery on the Comex exchange in New York. That was not a full month's worth of delivery notices. That was 4 days. It represented more than 60% of all the registered silver, the metal actually available for collection against futures contracts, sitting in Comex-approved vaults at that moment. And that was just the beginning. By late February 2026, according to CME Group vault data published daily on their website, registered silver inventory, the deliverable pool, had fallen from roughly 200 million ounces in September 2025 to approximately 86 million ounces. That is a decline of more than 57% in 5 months. As of the data published March 9th and 10th, total combined Comex inventory, both registered and eligible, had dropped below 370 million ounces. The headline number the exchange reports still looks substantial on the surface. But here is what almost nobody is putting together right now. In this video, we are going to establish 3 things you almost certainly do not understand yet, even if you follow silver markets closely. First, we are going to show you why the 350 million ounce total inventory figure is fundamentally misleading, and what the correct number to watch actually tells you about the system's liquidity. Second, we are going to examine a single data point buried in Comex delivery records from February 2026 that reveals something about institutional behavior that mainstream financial media has not connected to the broader picture. Third, we are going to place all of this inside a structural and historical context, including a direct comparison to the moment in March 2022 when the London Metal Exchange did something that shook global commodity markets to their core, and explain why that precedent matters enormously for what we are watching right now. By the end of this video, you will understand not just what is happening in the silver market, but why it exposes a fundamental tension between paper liquidity and physical reality that runs through the entire commodity banking system. So let us start with the data. The Comex system for silver warehousing divides inventory into 2 categories. Registered silver is metal that has been assigned a delivery warrant, a legal document authorizing its transfer to a futures contract holder. It is immediately deliverable. Eligible silver meets Comex purity and bar weight specifications and sits inside the same vaults, but the owner has not made it available for futures delivery. Think of it this way. Registered is the till, eligible is the safe. The till is what the exchange actually uses to settle contracts. The safe is somebody else's metal, being stored for their own reasons, and it only moves into the till if and when the owner decides to make it deliverable. That distinction is the first thing most retail investors miss when they see the 370 million ounce headline figure. According to data published by goldsilver.ai tracking CME Group warehouse reports, as of March 9th and 10th, 2026, registered silver, the actual deliverable pool, stands at approximately 78 to 88 million ounces, depending on the specific day's report, reflecting ongoing daily withdrawals. The Comex Stress Index, maintained by that same platform, assigns a coverage ratio, the percentage of outstanding paper claims, all open futures contracts multiplied by 5,000 ounces each, that could theoretically be satisfied by the registered inventory. As of March 10th, that ratio stood at approximately 13.6%. In other words, for every 100 ounces of silver committed to on paper through Comex futures contracts, only 13 to 14 ounces of deliverable metal exists in the vaults right now. Below 15% is defined as stress territory by that tracking system, historically rare and historically associated with delivery squeezes. According to data compiled and published in a detailed Substack analysis by analyst David Jensen of Gold Charts RUs, cited in a post published approximately 3 weeks before this video, registered silver declined from 200 million ounces at the start of September 2025 to 89 million ounces by the time of writing, at an average depletion rate of 20 million ounces per month. At that rate, Jensen's analysis projects exhaustion of the registered pool within roughly 62 trading days from early March, assuming current withdrawal pace continues without major restocking. Now, the Silver Institute's World Silver Survey 2025, researched and produced by Metals Focus, provides the supply side of this picture. According to that survey, the global silver market recorded a deficit of 148.9 million ounces in 2024, the 4th consecutive annual deficit. During the 4 years from 2021 to 2024, the combined shortfall reached 678 million ounces, equivalent to 10 months of annual global mine production. The Silver Institute itself announced in November 2025, at its annual Silver Industry Dinner in New York, that 2025 was on course to be the 5th consecutive year of structural market deficit, with the shortfall for 2025 estimated at 95 million ounces. Industrial fabrication demand, driven by solar photovoltaics, electric vehicles, AI data center infrastructure, and consumer electronics, reached a record 680.5 million ounces in 2024, according to the same survey. Global mine production in 2025 is estimated at 813 million ounces, according to Metals Focus, virtually flat year on year. Recycling is expected to hit a 13-year high, but still falls short of covering the gap. 5 consecutive years of deficit, 820 million cumulative ounces short of supply. That metal had to come from somewhere. It came from above-ground stockpiles, and those stockpiles are now visible in the Comex vault figures. Here is the counter-argument you will hear, and it deserves a serious, honest response. The standard objection to any analysis that focuses on Comex registered inventory is this. Comex open interest has always vastly exceeded registered stocks, and the exchange has always functioned because the overwhelming majority of futures participants never intend to take physical delivery. They roll contracts forward, they settle in cash, or they close positions before first notice day. The paper-to-metal leverage is not a bug, it is a feature that has existed for decades without breaking. The objection is structurally correct. Under normal conditions, delivery demand on Comex typically runs at somewhere between 2 and 5% of total open interest, and eligible silver can be converted to registered within 24 to 48 hours, expanding the effective deliverable pool when needed. These are not invented defenses. They are accurate descriptions of how the system has historically functioned. But here is where the data from 2025 and 2026 creates a genuine departure from that historical norm. According to the analysis published by Jinlo on Substack on February 27, 2026, drawing on CME Group's published delivery reports at cmegroup.com, February 2026 delivered 5,036 contracts, representing 25.18 million ounces of physical silver. That was the highest February delivery volume in modern Comex history. Speculative positioning, measured through the Commitment of Traders report, collapsed 77.72% year-on-year, from 54,415 managed money contracts in February 2025 to 12,121 contracts in February 2026. The people demanding delivery in February 2026 were not retail speculators chasing momentum. Speculative money had already been washed out. The delivery demand was coming from industrial users and institutional holders who wanted the physical metal, not a paper settlement. On first notice day for the March 2026 contract, February 27th, 10,526 contracts stood for delivery. That represented 52.63 million ounces of physical demand against a registered inventory of 86.13 million ounces. 59% of all deliverable silver in Comex vaults was being demanded in a single delivery period. The January 2026 withdrawal figure was also extraordinary. 33.45 million ounces physically claimed in a 7-day window, according to a trading key analysis published in January 2026 referencing CME delivery records, representing roughly 26% of the registered pool disappearing in a single week. The eligible to registered conversion buffer still exists, but the rate at which registered stocks are being drawn down is now outpacing the rate at which eligible silver owners are volunteering to make their metal deliverable. The owners of eligible silver are choosing to hold, not to convert. At these prices, they are waiting for higher. That is a rational decision for them, but it means the conversion buffer the standard objection relies upon is not automatically available. The till and the safe are not the same thing, and right now the till is running low, while the owners of the safe have no obligation to open it. This brings us to the section of this story that mainstream financial media has not connected clearly. In the CME Group's published monthly issues and stops report, available at cmegroup.com/delivery_, there is a detail that deserves direct attention. On January 29, 2026, 1,881 contracts were delivered in a single day, representing 37.3% of the entire February delivery total, concentrating on the very first day holders were permitted to demand delivery. That concentration pattern is important. First notice day front-loading of this magnitude, 37% of a month's delivery demand on day 1, does not reflect normal commercial procurement behavior. Industrial users typically stagger procurement through a delivery month. What it reflects, based on the delivery timing data, is that a significant portion of market participants were not willing to wait. They demanded metal immediately upon first eligibility, rather than allowing the usual roll or deferral. Now consider what was happening simultaneously in London. According to data and analysis referenced in an October 2025 article published by Physical Gold, a UK bullion dealer, 1-month silver lease rates, the cost of borrowing physical silver in the wholesale market, spiked to nearly 40% annualized in October 2025. Lease rates in a well-supplied market typically sit at 0.3 to 0.5%. 40% is not a minor disruption. It is the market for short-term physical metal borrowing essentially seizing up. As Investing.com reported in October 2025, citing Bank of America analyst commentary, London silver prices were trading $1.55 above New York Comex prices, an arbitrage gap that should close within hours as metal flows between markets. It persisted because the uncertainty around Section 232 tariff investigations, silver was added to the U.S. critical minerals list in September 2025, was making the economics of transatlantic shipment unpredictable. The physical market had fragmented into regional pools. Metal sitting in London could not freely relieve pressure in New York, and vice versa. By January 2026, lease rates had moderated from those October peaks, but, according to Trading Keys analysis published that month referencing Japan Bullion Market Association data, 1-month rates had re-escalated to around 8%, still roughly 16 times the normal baseline. An 8% annualized borrowing cost for silver is telling the market something specific. The entities that need immediately deliverable metal are paying a significant premium to access it. That is not a speculative price signal. It is a liquidity signal. And it is coming from the wholesale banking infrastructure that underpins global silver settlement. Here is what nobody is fully connecting. The LBMA no longer publicly publishes an official silver lease rate benchmark. The gold forward offered rate, known as GOFO, was discontinued in 2015. Since then, lease rates are derived indirectly from forward pricing and swap market activity, and are only available privately through dealers. Financial journalist Isabella Kaminska noted on X in October 2025 that this opacity is itself important. Because the published rates now depend on a small number of market participants, their accuracy and independence cannot be independently verified in the way an official benchmark could be. The Bank of England does not publish a direct silver liquidity facility the way it maintains one for sterling. There is no lender of last resort for physical silver in the way central banks backstop currency markets. When lease rates spike and physical metal becomes scarce in London, there is no monetary authority that can conjure silver into existence. The only resolution is higher prices incentivizing metal to come to market, or demand being destroyed at current prices. There is no third option. Now let us place this in historical context because two parallels are worth examining, and worth examining honestly, including where they hold and where they do not. The first comparison is 1979 and 1980, when Nelson Bunker Hunt and William Herbert Hunt accumulated a position in silver that, by most estimates, included 55 to 100 million ounces of physical metal alongside substantial futures exposure. According to Wikipedia's documented account and multiple historical sources, silver rose from approximately $6 per ounce at the start of 1979 to a peak of $49.45 per ounce on January 18, 1980, a move of over 700%. On January 7, 1980, Comex adopted Silver Rule 7, placing heavy restrictions on the purchase of silver on margin. The Federal Reserve, under Chairman Paul Volcker, simultaneously encouraged banks to stop lending for precious metals speculation. By March 27, 1980, Silver Thursday, the price collapsed from $21 to $10.80 in a single session as the Hunts failed to meet margin calls. A consortium of U.S. banks provided a $1.1 billion emergency credit line to prevent cascading broker failures. Where the parallel holds today: acute physical delivery pressure, lease rate spikes, and a measurable gap between paper pricing and physical availability. Where it does not hold: today's delivery pressure is not the result of speculative accumulation by a concentrated entity using leverage. According to the Jinlo analysis already cited, speculative managed money positioning has collapsed to 77% below year-ago levels. The entities demanding delivery in January and February 2026 are industrial users, solar manufacturers, electronics producers, data center builders, who need the metal for actual production, not for a speculative bet. That distinction matters enormously. The Hunt brothers' squeeze was caused by one side of the market applying artificial leverage. What we are watching in 2026 is structural industrial demand colliding with a 5-year accumulated supply deficit. The mechanism is different. The rules change risk is analogous, but the underlying driver is not speculation. it is necessity. The second comparison is more recent and arguably more directly relevant. On March 8, 2022, nickel prices on the London Metal Exchange rose more than 100% in approximately 5 hours of trading, reaching over $100,000 per ton, triggered by a short squeeze linked to a massive exposed position held by Chinese stainless steel producer Tsingshan Holding Group. According to the LME's own subsequent statements and court documents reviewed by Norton Rose Fulbright and cited in their legal analysis, the exchange suspended nickel trading at 8:15 in the morning and at 12:05 that afternoon canceled approximately $12 billion worth of trades, voiding contracts that had already been legally executed. The UK's Financial Conduct Authority, the Prudential Regulation Authority, and the Bank of England issued a joint statement in April 2022. The Administrative Court upheld the LME's decision in November 2023, ruling that the exchange had acted within its powers and that the urgency of the situation, multiple clearing members facing insolvency, justified the extraordinary intervention. The Office of Financial Research at the U.S. Treasury published a working paper in December 2024 describing trade cancellation as a novel and poorly understood tool for risk management, noting that it lies in tension with the function of a CCP, which is to ensure contract performance. That legal precedent is now established. An exchange can cancel trades. An exchange can suspend markets. An exchange can force cash settlement rather than physical delivery if the physical market becomes disorderly. Comex has equivalent emergency powers under its own rulebook. This is not speculation. It is documented in exchange rules. The question the silver market is now asking, not loudly, not in mainstream headlines, but in the behavior of participants demanding delivery as early as possible, is whether those emergency powers might ever need to be invoked, and what the consequences for price discovery would be if they were. So what should you be watching in the next 48 to 72 hours, and over the coming days? First, the CME Group publishes daily silver vault reports, available at cmegroup.com/delivery_reports, typically after market close each evening Eastern Time. The number to focus on is not total inventory. It is the registered figure, and specifically whether the current 78 to 88 million ounce range holds or continues declining. A sustained drop toward 50 million ounces would push the coverage ratio into territory that has no modern precedent. Each daily report is the primary real-time indicator of whether the March delivery cycle is stabilizing or accelerating. Second, the CME Group also publishes a monthly issues and stops report, also at cmegroup.com/delivery_, which records daily delivery activity for the March contract now that the delivery window has opened. Watch for front-loading concentration. If a high percentage of the total expected March deliveries are being claimed on the first available days, that is a continuation of the January and February pattern and confirms that institutional holders are not willing to roll forward or wait. If deliveries are spread more evenly through the month, it suggests the acute stress is moderated. Third, the Bank of England's Monetary Policy Committee minutes are scheduled for release this Thursday, March 12, 2026. While the MPC is primarily concerned with sterling interest rates and UK inflation, its language on financial market stability and commodity market functioning will be watched by LBMA participants. Elevated silver lease rates in London have direct implications for UK bullion banks and their balance sheet management. Any commentary on commodities market liquidity, even indirect, will be parsed carefully by the London precious metals community. To close, let us state clearly what this data actually shows and what it does not yet prove. Comex registered silver inventory has declined more than 57% in 5 months, from approximately 200 million ounces in September 2025 to approximately 86 million ounces as of early March 2026, according to CME Group Vault data. The coverage ratio, registered inventory as a percentage of outstanding paper claims, stands at approximately 13.6%, in territory defined as stress by market monitoring platforms. February 2026 recorded the highest physical delivery volume for that calendar month in modern Comex history, according to CME delivery reports. Silver lease rates in London spiked to nearly 40% annualized in October 2025 and re-escalated to around 8% in January 2026, according to Japan Bullion Market Association data and multiple market analyses. The Silver Institute and Metals Focus estimate that 2025 marked the 5th consecutive year of structural market deficit, with a cumulative 5-year shortfall approaching 820 million ounces. And the LME nickel precedent of March 2022, upheld by the UK courts, establishes that major commodity exchanges do have both the power and the demonstrated willingness to cancel trades, suspend markets, and force cash settlement when physical delivery stress threatens the solvency of clearing members. What the data suggests directionally, not as a price prediction, not with a date attached, is that the gap between paper silver and physical silver is not resolving. Speculative money has already been washed out. The participants remaining in the delivery queue are industrial and institutional. The silver that was available to absorb 5 years of structural deficit came from above-ground inventories, and those inventories are now measurably lower than at any point in the recent record. When inventory falls, and the entities demanding physical metal are doing so because they need it for production, not because they are speculating, price discovery eventually has to do the work of rationing supply. That process has not concluded. It is still underway. For the comments, if Comex were to invoke emergency cash settlement powers for any portion of silver contracts, the way the LME did for nickel in 2022, what do you believe the long-term effect on confidence in paper silver pricing would be? And would that change how you think about holding physical metal versus ETF exposure? That is a question that requires you to think through the plumbing of the system, not just the price chart. Thank you for watching. This video is for educational purposes only and does not constitute financial advice. All sources referenced, including CME Group Daily Vault and Delivery Reports, the Silver Institute's World Silver Survey 2025, the Metals Focus presentation at the Silver Institute's annual industry dinner in November 2025, Jinlo and Jensen analyses linked from public Substack publications, the LME court judgments, the Office of Financial Research working paper published December 2024, and the FCA and Bank of England joint statement of April 2022 are linked in the description below. Verify every figure independently before making any financial decision.